Africa just broke the banking system, and hardly anyone outside the continent seems to have noticed. While the world's attention has been locked on Western financial struggles, central bank interest rate debates, and the ever-looming possibility of recession in the United States and Europe, Africa has quietly begun reshaping the very architecture of global finance. The shift is not merely symbolic. It has the potential to alter how money flows across borders, how trade is settled between nations, and even how ordinary people in cities and rural villages access and use financial services. What is unfolding is nothing less than a structural transformation, one that challenges the legacy of colonial financial dependence and positions Africa at the center of a new financial reality. For decades, Africa was seen as a periphery of the global banking system, reliant on European central banks, French treasury accounts, and the dollar-dominated order of international trade. But quietly, leaders, innovators, and central banks across the continent began to ask the same question. Why should Africa remain bound by systems designed elsewhere? Systems that never truly served African economies? That question has driven experiments in digital currencies, mobile payments, regional clearinghouses, and alternative trade settlements. The outcome is stunning. Africa is not only leapfrogging the old model, it is building a new one from the ground up, and in many ways, it is already working better than what the West currently has. The first major crack in the global banking system began not with a central bank, but with mobile phones. Long before Wall Street took digital payments seriously, Africa had pioneered them. In Kenya, the launch of M-Pesa in 2007 changed the very meaning of banking. Suddenly, people without bank accounts could send money instantly from one village to another, bypassing physical branches and paperwork. This was not just a convenience. It was liberation. For rural farmers, for market women, for small shop owners, it meant they could join the financial system without waiting for banks to come to them. M-Pesa's model spread, inspiring similar systems in Tanzania, Ghana, Nigeria, and beyond. By the 2010s, Africa had created the world's most sophisticated mobile money ecosystem, handling more digital payments per capita than most Western countries. This was the first sign that Africa was not behind in finance, but ahead. What followed was an even deeper challenge to the traditional banking model. African governments and central banks, tired of dependence on Western clearing systems like SWIFT, began to explore alternatives. This culminated in the launch of the Pan-African Payment and Settlement System, PAPSS, backed by the African Export-Import Bank. PAPSS allows African countries to trade with one another in their local currencies, eliminating the need to first convert into US dollars or euros. For decades, the dollar had been the middleman in African trade. A Nigerian importer buying goods from Ghana would first convert naira into dollars, send those dollars through a US bank, and then reconvert into cedis. Not only did this cost money in fees and exchange losses, it also kept Africa tethered to American financial dominance. With PAPSS, that chain is broken. A Ghanaian exporter can be paid directly in cedis, while the Nigerian buyer pays in naira. Settlement is instant. The middleman is gone. This is revolutionary, even if most people outside Africa barely noticed. At the same time, digital currencies have entered the picture. The Central Bank of Nigeria introduced the enaira, Africa's first central bank digital currency. Though still in its early stages, it signals a determination to innovate beyond traditional notes and coins. Other countries are exploring similar projects, with Ghana piloting the e-cedi and South Africa studying its own versions. These experiments are not isolated. They are part of a broader continental move to create financial independence, to modernize money in ways that the old system, still dominated by dollar wire transfers and outdated banks, has struggled to do. For Africa, digital currencies could mean cheaper cross-border trade, faster remittances, and a safeguard against reliance on external currencies. For the world, it means Africa may soon have one of the most advanced monetary ecosystems on Earth. But perhaps the most dramatic shift is not technical, but geopolitical. Africa's banking revolution coincides with a global fracture in trust toward Western-led finance. Sanctions against Russia, weaponization of the dollar, and rising debt crises have all exposed the vulnerabilities of countries dependent on the existing system. In response, Africa has been diversifying. China's yuan is being adopted more widely in African trade. Bilateral agreements with Russia, India, and Middle Eastern states bypass the dollar altogether. African countries are also increasingly questioning the French CFA franc system, which for decades tied 14 West and Central African countries to Paris through currency control. Calls to abandon the CFA have grown louder, with countries like Mali, Burkina Faso, and Niger already distancing themselves. This is not merely about pride. It is about breaking structural chains that have siphoned wealth for generations. What makes this transformation particularly striking is its quietness. Unlike the headlines that accompany every Federal Reserve announcement or every European central bank policy move, Africa's financial revolution has unfolded without much global media attention. Yet on the ground the effects are massive. Small businesses can now trade across borders more easily. Governments can keep more value at home rather than sending it abroad in fees. Citizens can bypass banks altogether, using mobile apps and digital platforms to manage their money. This is not the image of a continent waiting for rescue. It is the image of a continent building its own system step by step, day by day. Critics in the West often underestimate the significance of these changes, dismissing them as minor or experimental. But they forget that Africa has long been the place where innovation takes root precisely because the old systems failed. When you don't have reliable bank branches, you invent mobile money. When you don't trust international clearing systems, you build your own. When the global order uses finance as a weapon, you design ways to protect your sovereignty. Far from being behind, Africa is becoming the test ground for the future of banking. Of course, challenges remain. Many African economies still struggle with debt, much of it owed to international lenders. Corruption and mismanagement sometimes undermine even the best designed systems. Internet access is not universal, limiting digital platforms in rural areas. And powerful global interests are not pleased to see Africa move away from dependency. The pushback is real. Western financial institutions worry about losing influence. International creditors want to keep leverage. Even some domestic elites tied to the old order resist change. But despite these obstacles, the direction of travel is clear. Africa is not turning back. Too much progress has been made, too much benefit has been seen, and too much determination has been built into the new systems. The symbolism of this shift cannot be overstated. For over a century, African wealth flowed outward. Gold, diamonds, oil, cocoa, coffee, all was extracted, all was traded in foreign currencies, all was controlled by external institutions. Now, for the first time, the financial pipes themselves are being rewired. Instead of value being siphoned off through colonial-era banking systems, more of it is staying on the continent. Instead of African economies being seen as mere appendages of European treasuries or American banks, they are standing as equal players. This does not mean Africa has broken free entirely, but it does mean the foundations of independence are being laid not just politically, but financially. The global implications are profound. If Africa continues on this trajectory, the world could soon face a multipolar financial system where trade is no longer dominated by a single currency or a handful of Western banks. For multinational corporations, it means adjusting to a continent that is no longer just a resource supplier, but a financial innovator. For governments, it means recalculating how sanctions and monetary policies might backfire. For ordinary people outside Africa, it may mean cheaper access to African goods and services as transaction costs fall. And for Africa itself, it means dignity, autonomy, and a chance to write its own future. The truth is, Africa just broke the banking system, not with fanfare, not with noise, but with quiet determination and innovation. And while the world has barely noticed, the consequences are already rippling outward. The real question is not whether Africa can sustain this transformation, but whether the rest of the world is ready to adjust to it. Because the future of money, trade, and sovereignty may already be shifting south. to a continent long underestimated, now rising, and no longer willing to play by rules written elsewhere. This is not a temporary experiment. It is the early architecture of a new global order, one in which Africa is not a follower, but a leader. And if you blink, you might just miss the moment when Africa's banking revolution became the world's financial reality.